We went into the final stretch of January, trading with metals acting like they had jet fuel. Big spikes, big headlines, big emotion. Then, right as the calendar flipped into delivery season for the front month contracts on the main US futures exchange, the market slammed the brakes. In 2 days, you got one of those violent up then down sequences that makes people question everything they believed 48 hours earlier. But here's the part most people miss. The market doesn't only move on truth. It moves on positioning. It moves on who's trapped. It moves on who needs to unwind. And it moves on the clock. Time matters more than most people want to admit. And I'm going to prove that to you in a minute with two simple historical patterns that investors still refuse to learn from. But before that, I want to lock the moment in because this is important. I'm recording this on Saturday, January 31st at 9:40 in the morning, New York time. Comment what time you're watching right now because I'm always curious how global this community actually is. Now let's talk about why prices can drop hard without the bigger trend being dead. When you get a fast run up, you attract a very specific type of buyer. Not the long-term stacker, not the industrial user, not the person building a hedge for the next decade. You attract the momentum crowd, the I'll buy it because it's going up crowd, the I saw it on a chart crowd, and that crowd does not have patience. So when the move pauses, they don't ask, is the thesis still true? They ask, can I still lock a profit? Then they smash the sell button. That's profit taking. It's not a moral issue. It's not even a bearish forecast. It's just what happens when a trade gets crowded. And profit taking can look like the end of the world when you're staring at a one-day candle. But if you zoom out even a little, the story changes. Now, let me hit you with the first time lesson. Back in the late 1980s and throughout the 90s, gold basically lived in a boring box. It bounced between the low 300s and the upper 300s, not because nothing mattered, but because the market was stuck in a rhythm. And traders who understood that rhythm made money over and over by buying the bottom of the box and selling the top. Then the box broke. In the late 90s, gold slipped under that floor. And once it fell through, it stayed down for years. Here's the key point. People who only understood fair value kept screaming it was too cheap, and they were right in the long run. But the short run lasted a long time. That's the part that hurts, because the market can stay wrong for years while still being perfectly normal. And if you don't respect that, you get shaken out at the worst moment. Now, the second time lesson. In the early 2010s, after that famous peak era in commodities, a lot of markets went into a cyclical decline. Not because the secular story died, not because the world stopped needing metals, but because money rotated, leverage got cleaned out, and the cycle took a breath. That decline lasted years. Then the secular trend came back. So the takeaway is not, it'll only go up. The takeaway is a trend can be bullish and still have painful stretches. And if you understand that the current pullback stops looking like a funeral and starts looking like a shakeout. Now here's the cliffhanger. The current pullback wasn't just emotional, it had mechanical fuel. And when you understand that fuel, you'll understand why it can reverse fast, possibly faster than the crowd expects. Let's go there. The front month contract was heading into delivery. That's a big deal because delivery periods force decisions. People who are short have to roll their positions forward or prepare to settle up. People who are long have to decide if they're taking delivery, closing, or rolling. And that rolling process can create huge bursts of buying or selling that have nothing to do with your aunt's opinion of inflation. So what happens? Shorts buy back the expiring month, then sell a later month. That's a roll. When a lot of shorts do it at once, it can send prices screaming higher. Then once that wave passes, the price can drop simply because the urgent buying is done. That doesn't mean the bull market ended. It means the calendar event ended. Now, to make this concrete, think of it like a stadium crowd. If 10,000 people rush through the same gate at the same time, it feels like a stampede. But once they're inside, the pressure disappears. The stadium didn't collapse. The gate just isn't crowded anymore. That's what rolling pressure looks like. Now, some people hear delivery and imagine trucks backing up to a vault like it's a movie. That's not how most of this works. A lot of what gets called delivery is really a transfer of claims inside the system. Paper changes hands, warrants change hands, and the metal may not move an inch. That's why a delivery window can create fireworks in price, even if the physical world is calm. And the physical world can be tight, even while the paper world looks liquid. But here's the danger. When the paper world gets too confident, it stops respecting the limits of the physical world. That's when you get those sudden spikes where nobody can explain why price moved in 10 minutes. So when you saw that front month high print, part of that was the market realizing, oh, a lot of people promised something and now the calendar is asking for proof. And then once notices start going out, another weird thing happens. Some longs don't want the hassle of staying involved. Some shorts don't want to be on the hook. So the same bars of metal can get delivered, then resold, then delivered again, all on paper. It's like passing the same hot potato across a table until someone decides to hold it. That's why you can see big delivery notice numbers early in the month and then see a bunch of it effectively get recycled as the month goes on. It's not a conspiracy, it's the mechanics of a financialized market. Now, if that sounds complicated, good. It is. And complexity is where most people get tricked because they simplify it into one sentence. Price fell, so the story is over. That's the lazy conclusion. Here's the smarter way to think about it. When the forced rolling ends, you're left with the organic bid. The organic bid is the person buying because they want exposure, not because the calendar forced them. That bid doesn't always show up instantly, but when it does, it can feel like the market mysteriously turns on a dime. So what do we watch to see if the organic bid is returning? 1, we watch whether dips get bought quickly or whether they bleed all day. 2, we watch whether the next month contracts stay supported or whether the whole curve collapses. 3, we watch the physical market. Do premiums stay firm? Do wholesalers stay tight? Do coin dealers stay backlogged? And 4, we watch the vibe and risk assets. Because when equities wobble, the bid for protection tends to wake up. Now, here's the cliffhanger I promised. The market can bounce even while the headlines stay scary, because a bounce can be driven by nothing more than the sellers are done. And once the sellers are done, the next buyer doesn't need a reason. The next buyer just needs a price. That's why these moments are so important, because if you blink, you miss the turn. And if you were watching those intraday highs recently, you saw that stampede in action. Prices made fresh records on the front month, then gave back a chunk. People called it panic, but a good chunk of it was simply positioning. Here's where it gets spicy. When open interest in the front month collapses, it tells you a huge piece of the market already made its choice. The roll happened. The urgent buying is behind us, so the price can sag. But what happens next depends on who's still left. If it's only weak hands left, the drop continues. If it's strong hands stepping in, the drop turns into a springboard. And right now, there are signs we're seeing more of the second than the first. Because the bigger problems that push people into metals didn't magically vanish over 2 trading sessions. They're still here. Now, let's talk about the political whiplash because it matters, but not in the simplistic way people think. We just watched lawmakers flirt with a shutdown scenario, then step back at the last second. Markets love crisis averted for about 5 minutes. Then they realize what that usually means: delays, patches, and more spending later. The short-term relief rally is real, but it's also shallow because the underlying incentives don't change. At the same time, we've got drama around the leadership of the U.S. Central Bank. Even the rumor of a leadership change can shake expectations because traders start pricing in a different reaction function. Will policy stay tight? Will it get politicized? Will it prioritize markets over purchasing power? These are not academic questions. They change the way big money positions. And here's my skeptical take. People act like a single appointment fixes credibility. It doesn't. Credibility is earned over years and lost in weeks. The market's memory is long. If the street senses that policy is becoming a tool, the risk premium doesn't go away. It grows. So when you saw the currency bounce on the news of things calming down, understand what you're really seeing. You're seeing traders unwinding a crowded bet, not the world suddenly becoming stable. And if you're thinking, okay, but what about war risk? Yeah, that's still hanging in the air. When you hear talk of naval deployments, threats, and chest thumping, you don't have to be a geopolitical expert to understand the basic investor reaction. Protect the downside. That's why gold jewelry demand and small bar buying tends to rise in regions that feel exposed. People don't wait for confirmation. They hedge first, then ask questions later. So if someone tells you, relax, it's all solved, ask them, solve for how long? Because markets don't price forever. They price the next surprise. And right now, surprise risk is still high. We've still got political risk. We've still got policy uncertainty. We've still got headlines that can change the market mood in one press conference. And we've still got the quiet, slow-burning problem that doesn't trend on social media: debt and currency debasement. Now, before I go deeper, quick reminder. Check the description because I've put bonus links down there, including a premium WhatsApp channel link and a channel membership join link. Those are there for people who want the updates and the deeper dives without hunting around. All right, back to the plot. Over the last couple days, we saw a mix of risk and relief and risk-off fear fighting each other. On one hand, some political drama cooled down temporarily, and that took some panic premium out of the market. On the other hand, international tensions didn't go away, and that kept a floor under demand. And here's the tricky part that nobody on the loud side of finance wants to admit. The same headline can be interpreted two different ways. A last-minute deal that avoids a crisis can spark relief, but it can also signal that the system is kicking the can again. And when the system kicks the can, the long-term consequence is usually more spending, more borrowing, and more pressure on purchasing power. So, you might see a short-term bounce in the currency and a short-term dip in metals. And then, as people digest what actually happened, the longer-term bid comes right back. That's why I keep saying, do not confuse a fast reaction with a final verdict. Now let's talk about the currency for a second, because this matters. When the dollar ticks higher for a day or two, people immediately run out and declare victory. Strong dollar, weak gold. That's the headline level thinking. But the deeper view is this. Currencies can bounce while still being in a broader downtrend. And if you're measuring the currency against the things that matter to real life, energy, food, housing, and hard assets, those bounces often don't change the trend at all. From recent market updates, the dollar has been in one of those choppy phases where it can fall for a stretch, then snap back on a political headline, then drift again. That chop is exactly the environment where metals can whip around and punish anyone who's over-levered. Which brings me to a question for you. Are you watching this as a trader or as an investor? Because if you're trading, you have to respect that volatility will eat your lunch if your timing is off. But if you're investing, volatility is often the thing that hands you the discount. And that's why I want you to hear this next part carefully. Even if gold pulled back a lot more from here, it can still be in a rising trend on the larger chart. Same for silver. That's not a prediction, that's just math. If you draw a trend line from last year's lows into the major consolidation periods, you can create a scenario where prices dip hard and still stay inside a bull structure. That's why the people screaming it's over after a sharp drop are usually telling you more about their time horizon than about the market. Now let's shift into silver, because silver is where the drama always gets extra. And silver deserves its own spotlight here, because silver is the metal that embarrasses confident people. Silver is half money, half industrial input, and 100% mood swing. When the market is excited, silver outperforms because it's smaller and easier to push. When the market is scared, silver underperforms because it's smaller and easier to dump. That's highlighting why a drop in silver can look terrifying, even when the longer-term setup is still constructive. Here's some context you don't hear enough. A growing chunk of silver demand comes from industries that don't care about the price on your screen today. Solar manufacturing is a big one. Electrification is another. Data centers, medical applications, power grids, and high-end electronics all rely on silver's conductivity. Yes, engineers can thrift and substitute in some cases, but there are limits before performance and reliability suffer. And supply isn't a simple turn the faucet story either. A lot of silver production is a byproduct of mining other metals. That means silver supply can't always respond quickly to higher prices because it depends on what's happening in copper, lead, and zinc markets. So you can have periods where silver demand rises while supply is slow to react. That's how tightness builds quietly. Now add the investor layer on top of that. When the crowd piles into silver, it shows up in the easiest vehicles first. When the crowd exits, the same thing happens in reverse. The physical market then has to digest that flow. That's why you'll sometimes see headlines about ETF outflows at the exact moment your local physical market still feels tight. Two layers, two different realities. So, if you're watching the silver move and thinking, maybe I should just avoid it, that might be rational for a short-term trader. But for a longer-term investor, the volatility is part of the opportunity. It's the price you pay for owning something that can re-prick violently when the world gets nervous. Now, quick question. Are you more bullish on gold or silver from here, and why? I want to see your reasoning, not just a one-word answer. Silver doesn't walk. Silver sprints, then trips, then sprints again. And what's happening under the surface in silver is actually the reason I'm not buying this. This is the end narrative. The next active delivery period for silver is still ahead, which means positioning pressure hasn't fully played out yet. And silver open interest, basically how many contracts are still in play, has remained heavy enough to keep the market sensitive. That sensitivity can be a curse if you're on margin, but it can be a gift if you understand what it means. It means the market is still alive. Now, let's talk about the elephant nobody wants to touch. ETF flows. A lot of retail investors treat ETFs like a scoreboard. If metal ETFs are bleeding, they assume the story is bearish. If ETFs are inflating, they assume it's bullish. But that's an oversimplification. ETFs are a vehicle. They reflect behavior, not truth. In a fast rally, people pile into ETFs because it's easy. In a pullback, some of those people sell because they want to lock profits. That selling can temporarily push prices down, not because the long-term fundamentals changed, but because the easiest vehicle is also the easiest exit. And when that selling hits the system, you can get a backlog in the physical supply chain, dealers, refiners, and wholesalers, because metal that was sitting in investor form is suddenly being converted, shipped, or reprocessed. It's messy. That mess can create short-term softness in price, but it can also set up the next squeeze because the physical world doesn't adjust instantly. Here's the cliffhanger. The people who sell during that messy phase often end up buying back later at higher prices because they confuse volatility with validation, and the market loves punishing that mistake. Now, you might be thinking, okay, John, but if this is just profit-taking, why did it hit not only gold and silver, but also copper, aluminum, and the rest? Good question. Because when a big macro trade gets crowded, the unwind doesn't politely target one asset. It hits a basket. Funds that run multi-asset strategies don't always sell one thing. They de-risk across the board. They trim what's up. They cut what's volatile. And they raise cash. That's why you can see base metals slide at the same time precious metals slide, even if the story for each one is different. Now let's go even deeper, because this is where the competitor-style narrative usually stops and where we're going to add value. Based on recently published numbers, silver's demand profile is shifting more and more toward industrial use. Solar panels, electronics, electrification, and grid upgrades all use silver in ways that are hard to replace without performance losses. That doesn't mean the price can't pull back. It means the longer-term floor is supported by a buyer that doesn't care about your chart pattern. And here's the twist. Industrial demand doesn't show up like a viral headline. It shows up like a slow squeeze. It's the kind of squeeze that makes pullbacks feel safe until they aren't. Gold has its own version of that. It's the ultimate balance sheet asset. It's what people turn to when they don't trust paper promises. And whether you love or hate the political situation, the fact is we're in an era where institutions and individuals have more reasons than ever to diversify away from purely financial claims. Now, I want to challenge one popular point that gets thrown around during sell-offs. You'll hear people say, if this was a real bull market, it wouldn't drop like this. That's nonsense. Real bull markets drop like this all the time. In fact, the strongest bull markets often have the most violent pullbacks because they attract leverage. When the leverage gets rinsed, you get a drop that feels personal. So the question is not, did it drop? The question is, who got forced out? And if the forced selling was mostly short-term players, that's not bearish. That's cleaning. Now, another angle that matters is inflation data, because a lot of traders treat inflation prints like a green or red light for metals. If inflation is hot, they buy. If inflation cools, they sell. But the truth is, metals respond to real rates and credibility. If people believe policy will stay tight and credible, that can pressure metals. If people believe policy will bend, wobble, or fail to keep up with price levels, that supports metals. And the latest inflation updates have been mixed. Goods prices can cool while services stay. That's a classic pattern. It's also why policymakers get trapped, because you can't easily crush services inflation without damaging the labor market. So you get this weird world where headline inflation can look fine, but the stuff people feel every day keeps climbing. And when that gap between official comfort and daily reality grows, people look for a hedge that doesn't require permission. Now, let's pivot into the longer-term bond question, because this is where the macro story really gets interesting. People love to ask, what happens if foreign buyers stop financing US debt? It's a scary question and fear sells, so you'll hear it constantly, but the reality is more nuanced. For one, demand for government debt doesn't disappear in a crisis. In many crises, it increases because big pools of capital chase perceived safety. So the idea that nobody will buy is usually a dramatic oversimplification. Second, not all so-called foreign holdings are actually foreign in the way people assume. A meaningful chunk can be domestic money held offshore through various structures. The ownership labels are not as clean as the headlines suggest. Third, domestic institutions are a huge part of the buyer base. Retirement systems, banks, insurance companies, and money market vehicles all hold government debt because regulations and mandates often push them there. That's not ideology. That's plumbing. And finally, the central bank exists. If the system ever hit a true no-bid scenario, the central bank can step in as buyer of last resort. That doesn't mean it's good. It means the system has a backstop. And here's the cliffhanger. The existence of that backstop is one of the reasons hard assets matter, because the backstop often involves creating more currency units. So even if bond auctions keep getting covered, the deeper question is what that coverage costs you in purchasing power over time. Now, there's a weird psychological trick here. When people hear bid to cover ratio or auction demand, they assume it means the currency is strong. But an auction can be successful while the purchasing power still erodes. Those are two different conversations. One is about market mechanics, the other is about living standards. So if you're stacking metals because you're thinking in decades, the short-term auction chatter is not the whole story. Now let's get practical again. What should you expect next? Here's my base case, and I'm going to phrase this carefully because nobody controls the market. I wouldn't be shocked if we see a rebound attempt as soon as the next trading week, not because the market owes it to us, but because the forced buying and forced selling that created the whiplash is already cooling down, and the underlying demand drivers are still on the table. But then, even if we bounce, I also wouldn't be shocked if the market enters a messy plateau later in the first quarter or the middle of the year, where it chops and frustrates everyone. That chop is where weak hands quit, and that's where the next move tends to get built. So if your entire plan is based on needing every week to be green, you're going to hate this environment. But if your plan is built around building a position through volatility, this is the exact environment where patience can actually pay. Now let's address the price level obsession, because this is where people get lost. Yes, prices can fall a long way and still be bullish on the bigger structure. That is true. But that doesn't mean you should ignore risk. It means you should respect the difference between a pullback and a collapse. A pullback is a retracement that cleans leverage. A collapse is a fundamental break. Right now, the evidence points more toward cleaning than breaking. And the reason I say that is because from the publicly available positioning data, the market recently had the kind of crowded front-mon exposure that almost always leads to a shakeout. Those positions have been reduced. That's the market exhaling. If we were seeing a collapse, you'd likely see a different pattern. Sustained selling across multiple weeks, breakdowns in physical premiums, and a broad loss of interest. We're not there. Now, I'm going to ask you something, and I want a real answer in the comments. Do you think this pullback is shaking out traders, or is it changing your long-term view? And while you're there, if you're successful, share your success story in the comments so others can stay motivated. People underestimate how much a real story can help someone else hold through the noise. All right, Quick detour to platinum and palladium because these metals matter and they often get ignored. When the market de-risks, these metals can get hit hard because they're thinner and more volatile. They're also tied to industrial cycles and automotive trends, which adds extra layers. But the long-term story in that space has its own weird twist. The world is trying to shift technologies. Supply chains are tight in pockets, and substitution isn't always easy or immediate. So those markets can swing violently. If you're watching them, understand this. A big drop doesn't automatically mean the thesis is dead. It often means liquidity is thin and traders are cleaning positions. Now, I can't leave without tackling the geopolitical angle because it's part of the current bid.